Hello, everybody, and welcome back to another episode of the Mills Knows Bills podcast. I'm your host, as well as current CEO of Mills Knows Bills, Mills Bender. And with me today, I have the one and only Sean Casper, who I've heard a lot about, and we run in very similar circles, but this is actually our first time chatting. So, Sean, if you would, share with everybody who's watching or listening a little bit about yourself, and then we'll talk about what you do and why you're here today.
Perfect. Thank you for having me. We'll start with that. So I'm Sean Casper, and great to meet you and being here. We've exchanged emails and talked a couple times, but it's good to finally get on here. And I know you've had a dear friend of mine on here before, Carrie Sobel, who was the best man in my wedding. I was his best man. I don't know if you know that.
I didn't.
So we've known each other for 30 plus years. So it's a small circle. But I live in South Florida, originally from Philadelphia. I've been in real estate my entire adult life, so 15 plus years, I think probably more than that at this point. Started off in residential real estate, so got my real estate license back in 2009. Not the time where you wanted to get your real estate license, but I guess caught it on the upswing at that point. So right after the recession or middle of the recession, got my license, started doing rentals, and at the time, you could advertise on Craigslist. You could advertise rentals on Craigslist. And now it's so saturated, or only a couple years maybe after that it got saturated. But that was the best place to find rentals at the time. So I was advertising there and just representing clients looking for rentals. Then started getting into the sales side of real estate. So for 2-3 years, I was selling as a residential realtor. Got my broker's license, and I had always had other agents that were veteran agents or newer agents in the business that had come to me and said, can you help me generate more leads? I see what you've been doing, or what are you doing for marketing? How are you growing your business? And I loved helping other people. And maybe that's why I was a decent agent, because I helped people buy and sell and rent homes. And the founder of the company came to me and said, we're going to open an office in Fort Lauderdale. I think you'd be a good manager. Can you sell homes while managing other agents and slowly transition into management? So for about 3 months, I did that. And then I said, if you want me to be a good manager and put all my eggs into this basket and help other people grow, I have to stop selling. So went to the leadership side. I did that for about 10 years. We were acquired by Compass, the publicly traded residential firm, back in 2020. Where then I moved over to Compass. I was the managing director of Florida. I had 3,000 agents I was managing and 189 employees. And my first taste of a real corporate organization, one of the best companies I've ever worked for. Nothing bad to say about Compass. It's a great company. But my whole career, I had always participated in the growth of the business and in the bottom line. So the more that I helped other agents produce or salespeople produce, that directly affected my income. And when you move into a much larger organization, a lot of that can change, right? It's just different. It's not as set up as a smaller business, where I played a key role in kind of growth, right, and navigating the waters to the bottom line. So at the time when I was at Compass, I was deciding what is kind of going to be my next move. I've been in residential real estate at the time for 10 years, and I still wanted to stay in real estate. So I had a couple different opportunities, partnering potentially in a title business, acquiring a business that was in print marketing for agents, so still around the real estate world.
Yeah.
And then our CEO, Greg, who you've met before, at Coastal, I have known him also forever. He was a groomsman at my wedding, and I had already been investing with Coastal up to this point. This is around, I guess, 2020, 2021, beginning of 2022. And he said, he called me one day and said, how are you doing? What's going on with work and whatnot? And I said, I got a really busy day. I can't talk. I have 18 Zoom meetings. I'll call you later.
18?
And then he said, yeah, something like that. It was busy.
Word.
We were busy. We were in super growth mode. It was awesome. It was a really fun time at Compass. And then, but at the same time, I'd been maybe looking for something else. So he said, I might have something for you. And he had called me an hour later and said, I want you to come on board with me, partner with me. You've grown businesses before. I'm looking for somebody like you. You understand the real estate business, and we really want to grow this thing, because it had just been him and Tyler and Keith, the three partners and a few people coming in, investing their own money and bringing in some money from outside investors. But it was really at this point of like to go to the next, take a real trajectory and go to the next level. So that was, now it's been 3 years. I just had my anniversary. So I'm a partner at Coastal. We're a private real estate investment firm. I'll let you maybe ask some questions or we can get more deeper into that. But that's sort of been the transition from college through all real estate, which I don't think you've kind of heard my story, but that's kind of
No,
where
I
I got
loved hearing it though. It's actually interesting. You and I have quite a few overlaps. I am also from South Florida, and my family owns a print marketing company. So I
into.
always jokingly say it's not, there we go. It's not blood in my veins, it's ink. And so I know
Right.
that jargon, and most of their clients when I was growing up were real estate agents or companies, and so I understand all of that component of it.
What
But
was the name of the print firm, or is the name?
Station America,
Okay,
yeah,
got it.
originally Image Station of America, but
Okay,
that
very
name
cool.
got changed around 2010-ish, if I had to
Yeah,
guess. I don't know. I don't know. It's
awesome.
been a
Yeah,
while.
great business. Great
Yeah,
business. Everyone I
yeah.
know that's in print does pretty well. We have a lot of clients in it as well.
They do a great job. It's tangible. It's easy to understand, easy to sell, but I digress. Let's
Yeah,
talk
no
about
worries.
Coastal,
Yeah,
because our audience who listens to the podcast are business owners or aspiring business owners who have a desire to sell their company at one point and realize this nice, pretty capital gain at the end of
yeah,
it. And so let's talk about what Coastal is, and then we can talk about the solution side that
sure.
Coastal provides. So, what is Coastal?
Yeah, so we're a private real estate investment firm. We invest in a handful of different asset classes, from multifamily to self-storage, car washes now, which we can get into, senior housing, a lot of different alternatives, primarily real estate, as I said. About 80% of the deals that we invest into, the funds we invest into with the development partners we have is strictly real estate. And then 20%, I'd say sometimes it's 70-30, sometimes it could be 90-10. It depends each year what our appetite is. But the other 20% is through Coastal Ventures, which would be growth equity into companies that are mid-stage companies. So not startups and not public company. So all private companies that are looking to IPO at some point within the next 2 to 6 years. For example, we did one with a company called Equipment Share last year, or maybe a year and a half ago. That was the third largest construction equipment company in the country. And now we're doing another one in the drone defense sector, which we're really excited about. And we'll typically do one or two of those a year, and the rest is real estate. So we're really an alternative investment firm, mostly real estate, but also some growth equity deals. We invest all of our own capital. So the partners do, which is originally how we started out. And then we allow friends and family, friends of friends, other business owners to participate with us alongside us in the deals. And just to sort of give a real simple example, let's say there's a developer building a 364 unit apartment complex in Charlotte, and it's going to cost $80 million. They're going to need, say, $35 million in equity. The rest is going to be debt. Of that 35 million, maybe the developer will put in 5 million, and then they're going to get that other 30 million from a group like us and maybe a couple other groups. So we'll put in our own capital, and our investors, we have close to 800 of them at this point, will come in with us and participate on the deal and on the upside, directly alongside us in the funds. So go ahead.
So, I mean, I'm just going to ask the questions I know that somebody listening to this is going to wonder. Why would somebody invest through Coastal rather than a traditional stock portfolio?
Yeah,
What's the
really good
difference
question.
there?
So the old uh, makeup of a portfolio, or
Hmm.
some people still hear it now, maybe from their advisors, is 60-40, right? 60% stocks, 40% bonds. We've believed that there should obviously be a component of alternatives within a portfolio, but even recently, Larry Fink, who's the CEO of BlackRock, said really the new diversification should be 50-30-20, right? 50% stocks, 30% bonds, 20% alternatives. So private assets. right? Could be real estate, could be growth equity, could be venture capital, private equity, crypto, whatever it may be. And so we believe that that's what a portfolio should look like now, which is part of the conversation we have with a lot of our clients during that initial call. Now, let's say a client of ours or a high net worth individual, a business owner, went to their advisor and said, hey, I want to invest in private equity. I want to invest in an alternative investment. Typically, the advisor is going to say, oh, we offer that, right? It's this menu of services that they have, and it will be a fund of maybe 200 of our projects wrapped into one fund, uh, sold to a very large institution. That institution then will put it out to wholesalers, right? Big banks and financial advisors. They then send it to their clients to potentially invest into. But originally, the manufacturer of that asset that built it, leased it, sold it to that large fund, it's almost like the manufacturing business, right? By the time it gets to the consumer, all of the returns have been, or all the profit has been diluted over the path of it, right? So there's this large funnel at the top of investing in, say, a large fund, and then as it goes down, the returns get stripped out of it over time. To where if you're going to invest into it into the market, you might end up with a 4 to a 7% or 8% coupon, a return or dividend coming out of that. While when you invest with the manufacturer, the actual developer, into a direct investment, we're looking at returns in the high teens to high 20s from an IRR standpoint, right? So when you compound that over time, within private equity or private real estate investments, it ends up being an astronomical difference over time. And most advisors don't have access to direct investments because it's not part of that menu of products, which is why most people don't get access to it. But as we've learned over the years, people that have been investing in alternatives for a very long time, they'll look at our deals, they'll look at the track record, they'll look at the development partners we invest with, and they'll immediately make a decision. It's harder educating people that have not been in alts, that have just had their money with an advisor, especially, a younger generation. I mean, you and I seem like a similar age, where people are coming into their full stride. They're doing pretty well. They're making some money and building some net worth. They're just listening to everything their advisor says, and the advisors typically aren't saying, hey, you should really go into some direct investment. So we wanted to fill that gap, that void, and we feel like a lot of successful people that might not be getting access and just aren't educated on it, and just don't have the ability to really understand it and get a first crack at the deal before it kind of goes down the line.
Well, I don't remember who said it, but someone said, if you don't understand it, don't invest in it. Well, I would almost challenge that and say, if you don't understand it, try to understand it. And then if it doesn't make sense, then don't invest in it. Because there are components of it's too good to be true in some scenarios, but this is not that type of scenario. I mean, I've sat down with Carrie, Greg, Rich, and learned a lot about the structure of Coastal to make sure I understood it, because I've been aware of alternatives for a while, but I've not found the right group the way that I've seen Coastal show up, which is really cool. I do love the diversification piece because, yeah, high teens to high 20s of a rate of return sounds great, but you need to make sure that it's diversified and you're hedging your risk, which is, not a lot of financial advisors will talk about that, but they'll only talk about it within the realm of what they have access to, which might not always be in the best interest of the investor themselves. So when you're sitting down with somebody who's interested in alternative investments, how do you find with them? And this might not be a you question, so if it isn't, forgive me and just tell me.
I think it is a me question. So go
All
ahead.
right. So how do you find what would be a good asset class for them, and if it even makes sense for them as an investor themselves?
Sure. Yeah. So we want to find out what their investment objectives are,
Mm-hmm.
where they are at in their life. Do they have a good amount of income? Do they have a large amount of a large net worth, or they're sitting on a lot of liquidity? Are they going to continue to work for a long time, where income might not be their first priority, and it's more growth? or are they, a little bit of an older generation that is phasing out of work and they're just looking for more of an annuity, and they want to be a little more risk averse. So for us, we find out, what are their objectives, and then how can we diversify a portfolio into different asset classes in different geographical locations, with different sponsors so that they're just spread out. We have a lot of clients that'll go into one or two deals, and then we have some that, we'll say I have $500,000 or $1 million or $5 million, and we'll diversify that for them into a handful of different asset classes and deals right up front. Some people want to start slow and start with one. The minimum's $100,000. So some people start there, go with one deal, want to kind of understand us, understand how our investment portal works, what kind of information are they going to get, what kind of updates are they going to get, how's the communication going to be, or the operations, and then do more. So people can go at their pace, however fast that they want to, but that's how we'll typically, have that first initial consult and understand what are their objectives, and how can we help them. And just to, when we say high teens and high 20s, for people that don't understand, from an IRR standpoint or an ARR standpoint, that's, obviously on an annual basis. And it's all broken down bit by how we're targeting investing in one of these funds. Let's say it's a multifamily project, and then building it, leasing it, and selling it over a 4 to 6 year period, or, depending on how long it'll go, sometimes 3 to 5, could be 2 to, it just depends on how it's structured. And that would be net IRR to investor, right? After fees. So we have to make sure that when we're, talking about returns and things like that, that there's gross IRR, net IRR, and before, after fees, so things like that. So, that's how we're structured. So our last, just as an example, our last one that we exited was a self-storage facility in Champions Gate, Orlando. So not all for you. And it was just under a 24-month hold. So just under 2 years. And we hit a 26% net investor level IRR. So if somebody put in, 100K, it was 152 they got back, or, $1 million, $1.5 million too. So that's kind of that mid-20s was our last exit. So that's typically what we're going for on the deals that we invest into.
We talk about education, and that being a piece that is an obstacle for some people when it comes to investing. So I know that hopefully this is step one for somebody, but what I will also say is Coastal as a group, you guys do a great job of educating and making sure that the investor has all the information necessary. I've seen it firsthand. Secondly is that access point. And I know that we were talking about $500,000 and $1 million, and that might be for the business owner who sells and has a huge surplus of cash at that one time, right? But what about for somebody who maybe isn't a business owner that's selling, or maybe they just don't have $500,000 to invest right now? What is that, for lack of better phrases, cost of entry to start getting exposed to these types of investments, so that way they can start, reinvesting back in and building that wealth?
Yeah. So our minimums are $100,000 on most of the funds. Some can be 250. And then on a lot of our growth equity investments, which we only do 1 or 2 a year, they can be, as low as $50,000. For anyone to invest with us, you have to be an accredited investor. So for those that don't understand that, it's either, if you're single, it's $200,000 in income a year. If it's a married couple, combined, it would be $300,000, or a net worth of over $1 million, excluding your primary residence. So you have to be an accredited investor, which allows people to get access to more sophisticated investments, and them being deemed to be aware and understanding that it is a more sophisticated investment versus going to their advisor and buying, one stock. So $100,000 is typically the minimum. And we have people that I've spoken to 2 years ago, and they said, I'd really love to do this. I just can't afford it right now, but I want to get involved. I, should have some bonuses or liquidity events coming up, and we stay in touch with them. And then all of a sudden, 2 years later, they say, hey, I have the 100,000, I want to go in. So we've got a lot of people that start with that. And then we have some that go up. We don't, discriminate against what somebody has. We would love for people to get involved and participate with us, and us guide them what we do with our own money, and that they don't only have to invest into the stock market or take advice from other people, and to listen to us and our advisory board, which is where a lot of our investing experience comes from, not just us.
I also follow y'all on Instagram, and I recently saw a reel about how you can leverage your Roth IRA and the funds within that to invest. Can you share a little bit more about that?
Yeah, so it just gets back to the public and the average accredited investor isn't privy to a lot of this stuff. They don't understand.
Mhm.
They're not told a lot of this stuff because let's say you work for a company for 10 years, you have a 401k, uh, or you set up your own IRA, and then you leave the company. While you're with the company, you can't decide what you want to do with it. The company's going to invest it. You could say, I want, A, B, or C from a risk profile standpoint, but you really don't have control over where that goes.
Mm,
When you leave the company, it becomes yours, right? If you rolled it over
yeah.
to an IRA or whatever it may be. At that point, let's say it's with a bank or a wirehouse, it's
Hmm.
it's being invested by an advisor or their advisor. And a lot
Hmm.
of people don't understand that you have control over that. You can decide what to do with it. You
Hmm.
could take it and give it to your own financial advisor, or you could self-direct it. So
Hmm.
we have the way that it works is, let's say if you had an IRA, there are a lot of groups out there that we work with and that are out there. That two of them we work with is Equity Trust and New View Trust,
Hmm.
where you can self-direct your IRA to one of those custodians, and then you
Okay.
can decide to invest it in whatever you want into our fund. So we have a lot of clients that have IRAs, and they take a piece of that IRA, self-direct it, invest it direct into the coastal fund, which you don't get hit with the tax penalty that you would if you just liquidated the IRA. It goes
Hmm.
into a coastal fund. All the income and distributions go back through into the
Hmm.
IRA, and then once it liquidates, you could put it back to the IRA or keep it with that third-party custodian. It's the fees are very nominal when it comes to using a self-directed IRA, no different than an advisor. And so we have a lot of people that use self-directed IRAs to invest into coastal funds. From that standpoint, it's I think it's a good way again to diversify
Yeah.
into that 50-30-20, or that's just what the CEO of BlackRock said, but which I just saw about a month ago or something like that. But when most ultra high net worth individuals sometimes have over 40-50% in alternatives,
Yeah.
right? It's
Well, they
just
can afford the risk.
correct. And we feel um, when it comes to risk, I don't necessarily know if they can afford the risk. I think maybe they have more experience in achieving the net worth that they've gotten to by taking risks that are calculated.
Fair.
For example, we won't invest with a developer that's ever lost a dollar of an investor's principal, right? So
Mm,
our whole thing is capital preservation and then upside from there.
okay.
But risk is definitely a subjective word.
Oh,
Uh,
1,000%.
from
Thousand
that
percent.
standpoint.
I was
Yeah.
talking with a financial advisor the other day who wanted to, just for shiggles, put me through his risk tolerance questionnaire. He's
Hmm.
like, if I could make it a higher number, I would. It's like
Yeah.
I'm young. I have time to recuperate things, like I want to take as much risk as I possibly can. But talking about risk, return, we hit upon the return side of investing through coastal. We briefly talked about the taxes. And I think that is such a beautiful add-on, I would say, to what you guys do. So talk about the tax side of investing through coastal rather than other types of investments, whether they're traditional or
Coastal was originally started for saving on taxes. So Greg, our CEO, like a lot of your clients who are business owners that were, within 5 years of selling,
hmm
had sold a number of businesses, pieces of companies, and ended up having some large tax bills. And after paying a very large one, he said to his accountant and his advisors, I don't want to go through this again. There has to be a better way. And he assembled the team of Avengers, or as he calls them, the Nerd Herd.
the
Uh,
nerd herd.
the
No,
guys and girls with the letters behind their names.
I love it.
Uh, and looked at some different private equity strategies and said, well, if these people are doing it and figuring out how to utilize depreciation and other tax codes and qualified opportunity zones and things like that to reduce his income, how can he implement that as well, and how can he share that with other people that he knows? And so he had put together some strategies with his advisory team on how to do that, and implemented them, and saved and ended up sharing that with other people. So as I'm talking through this, just to give you kind of one example, in the 2017 Tax Cuts and Jobs Act, it allowed for 100% accelerated depreciation on specific assets. So as an example, we purchased a fund of gas stations and convenience stores, which C stores, if they sell more than 50% petroleum to the products, it qualifies for 100% accelerated depreciation. And what we did was we actually leveraged some of these C stores with debt. So when you invest into it, and let's say you were to put down 30%, and then you had 60 or 70% of the financing, you get the 100% accelerated depreciation on the full amount, which can offset, depending on your fact pattern, potentially ordinary income as well, not just passive income. And then we have a handful of other tax strategies, whether it's oil and gas or equipment share, which is the company that we invested secondary shares in. That is a very strong tax strategy to help people offset ordinary income or capital gains. So we have a team of this nerd herd, like I said, or the wizards, and they actually read the tax code, identify the tax codes, understand how to turn them into a investable product,
Okay.
which can then be turned into a security that we can invest into and our investors can invest into it. So there's one thing about understanding a tax code. Then you have to figure out, how do you invest into it, and how can somebody facilitate it, right? Let's say you said, okay, we can get accelerated depreciation, we can buy some convenience stores, we can figure that out, or buy some gas stations or car washes or whatever, investment properties. We have the partners and the developers that actually we partner with to be able to go and acquire them, right? And or develop them. So there's a lot of different steps through that versus just understanding something and being able to implement it. And we have a lot of calls with our clients' accountants where we're educating the accountant on how this tax code works. And I can't provide tax advice. This is just coming from what I've learned from our advisors, and any of our clients or your clients would obviously talk to our advisors and have that introductory meeting to learn more about it. But we do this for ourselves, and these are just different strategies that we've implemented to help people generate good returns and save on taxes.
That's so cool.
Yeah. If that helps answer that.
It does. And it's always so interesting to me to see how many ways there are to approach business, but also how to approach lowering your taxable income and making sure that you're doing it the right way. This is just like on steroids. It's
Yeah.
the next level.
Yeah, and these are just some of the strategies that we have. Everybody has a different fact pattern depending on your business, right? A lot of people that are business owners don't even really know that they probably shouldn't be renting the space that they're in. And if they were to buy it and maybe lease out some of it, they could get the depreciation on the building. Just these little things that obviously you understand, as a CFO. But these are things we help educate our clients on. And we have an in-house chief acquisition officer that can Carrie, actually, Sobel, that can help guide people that are looking to sell their business on preparing it and packaging it up. So that way, when you do exit, you're exiting with the right structure, from a tax standpoint. And, we have some of the lawyers of the likes of DLA Piper and McDermott, Will and Emery, which are some, national and international firms that help us kind of package up businesses, whether someone's selling for 5 million or 500, million, to help them and guide them through the right way to structure these exits. And we hope by providing the tax advice and helping them structure it and assisting in them selling their business, and if we could save them some money on taxes, to partner with us and invest alongside us in some of the funds that we go into.
We're coming up on time over the next about 5 minutes or so. What is something that I've not asked you that you feel like we should educate the audience on?
I would say we've talked about minimums and returns
Mhm.
and different asset classes, but I think the most important thing is starting to dip your toe. You
Okay.
had mentioned, and if I heard this right, that uh, people don't invest in what they don't know.
Hmm.
You didn't know how to be a CFO before you became a CFO.
Right.
I didn't know how to sell a house in 2009 when I learned to sell a house, right? You learn everything. You start with nothing.
Yeah.
So I think not believing that alternatives is this mysterious behind the curtain,
Hmm.
investment world. People have been doing it forever,
Yeah.
and owning and investing in businesses. So I think getting educated, taking a meeting, learning about it, seeing
Yeah.
if it's something for you, and dipping your toe in the alternative world is would be a recommendation that I would have for people, right? I was
Yeah.
flipping homes myself, not investing into these types of deals. And then when I was approached and I learned more about it,
Hmm.
I thought that it would be better than me dealing with tenants, toilets, and trash and contractors to investing
Yes.
on my own. So that
Yeah.
I would say would be my thought process is get educated and dip your toe in it. Start
Mhm.
small if you want and learn more about it.
I also love the fact that it's allowing you to invest in real estate without having to handle everything like you just mentioned. Because I owned a property before and I hated running it. It was like I was owning a third job, you know? And it
Yeah.
was
Look, I mean, imagine being a surgeon with 4 children and you leave the house and you're in surgery for 12 hours or however long it
hmm.
might be. And you want to invest in real estate because you want to diversify your portfolio. How are you going to do that?
Yeah.
How do you have the time to do that? We have
Yeah.
a lot of athletes, lawyers, doctors, surgeons, all types of people that invest with us who just don't have the
Yeah.
time or the energy, but they have the capital to do it and want
Mhm.
access to it. So
That's
it's
really cool.
yeah.
So, how can somebody get that educational meeting with you? What's the best way for them to contact you?
They can reach out to me directly,
Okay.
Sean at coastalinvco.com if you don't mind sharing some of that information.
Not at all.
Or they could email us at relations@coastalinvco.com. You could visit our website, investwithcoastal.com, and you can get access to all of our open opportunities, learn more about our team, our advisory board, our investment strategy, our due diligence process. So uh, that would be the best way. Shoot us an email or visit our website. And
Thank you.
follow us on
And
Instagram, Invest with Coastal.
yes, follow on Instagram. Some of the reels are a little unhinged in the best kind of way. I
Uh,
always I always
we
laugh.
like to throw some parody skits in here
You
and there. We got
you
some
do.
more. We got some more coming up in
Oh
a few
no.
weeks. Will be funny. So yeah, we're excited about it. We try not to be you know, the suit and tie P from like a
Definitely
lot of
not.
that are out there.
No. Well, if you're watching or listening to this podcast episode, make sure you follow them on Instagram, reach out to Sean directly, or just peruse their website. All of the links will be in the show notes or video description below. Thank y'all for joining me on this episode, and I will catch y'all next time.